Hey everyone, welcome in to another daily editorial here on the KE Report. In this daily editorial, I am joined again by Byron King, geologist who writes for the Paradigm Group, formerly Agora Financial, also writes alongside Jim Rickards. Now, Byron, we're going to focus on the resource markets, a couple different resource markets here, starting with the energy markets and starting with the oil market in particular. Crude went through a pretty tough, let's say, month or about 2 months actually. Start of October rolled over from about $95 a barrel at the tail end of September and trended lower and lower and lower. And it was just a couple days ago, earlier this week, that it dropped below $70 a barrel. Ever since that Fed meeting on Wednesday, oil has popped back up. And as we're recording this, it's a little over $71 a barrel. Byron, do you think that possibly we could see, or we could have just seen a low put into the oil market after that 2+ month sell off?
Well, hello, Corey. Thanks for giving me a call. And yes, I do. I think that we are rolling in a slow climb. Let's say I call it a slow climb out of the lows of recent months. I think that those lows of recent months had to do with, a year and a half of rate raises that just sort of, raised the cost of money in terms of interest rates, of course. And also, I think that oil price declines have reflected, you might call it a very, very quiet global recession that was a reaction to the inflation of the last couple of years when a lot of prices just sort of shot up out of control. So there's some macro things going in there. But in terms of what is controlling the markets right now, the idea of lower rates that the Federal Reserve is coming up with, that's one macro issue. Another sort of macro issue is basically that Saudi Arabia, and Russia are talking about implementing formal cuts to output. We should note that on January 1st, at the beginning of this new year, a couple of OPEC nations are going to be rolling into that BRICS, that Brazil, Russia, India, China, South Africa, that BRICS group. So we got Saudi going to join, UAE going to join, Iran to join. So a lot of oil producers are going to go into that. BRICS is going to become BRICS OPEC. I think they're going to turn the valves, drop the global output, and keep the price at least where it is, but likely moving up. I don't think in a rapid way, but gently as the year begins to unfold, 2024.
So, Byron, when you're looking ahead to the oil price, then you even mentioned it. Look, there's recession fears that can play a role in oil heading lower. Then there's also lower interest rates and a more risk-on environment that investors have for markets broadly. So those are two push and pull factors. And we can also tie in OPEC. They clearly want higher oil prices, but we've also seen the U.S. production rig counts and numbers grow to levels, all-time highs actually, just entering this month. So which one of these factors can truly take over in your eyes?
I think what's going to take over is that obviously 2024 is an election year, and the Federal Reserve understands politics. If they understand anything, they are not going to have a formal recession in 2024. That said, there are a couple of economies out there. There's the economy that lives off of the government spending, just the hemorrhaging of dollars. I mean, we're in December now, so that we're 2 months into the U.S. government fiscal year. In the first 2 months of this fiscal year, 2024, for the U.S. government, Uncle Sam has collected something like around $650 billion with a B billion dollars of taxes. But also in those first 2 months, Uncle Sam has spent over $1 trillion. So we're already at least $350 to $400 billion in deficit just for this fiscal year. You do this for another 10 months until next September 30th of 2024. I mean that's a lot of federal money that's floating around out there, juicing into the economy. All of that said, there's like the economy out there of people that have money, and then there's the other economy. I don't mean this in a disrespectful way, but just the economy of the Walmart shoppers, of the dollar store shoppers, the Dollar General shoppers out there who are just there stretching every paycheck. They're stretching every Social Security check as tightly as they can. And you hear that reflected in, say, conference calls with, say, Walmart management or Target management or Dollar General management. They talk all the time about how stretched their customer base is. This isn't the Boca Raton people or the Beverly Hills people. There's no recession there. But and so there's a couple of economies at work out there. And we're talking these big sociological or macro trends or whatever, but these are things that are competing with each other, in a dynamic way. But the bottom line, I think, is that as 2024 unfolds, the Fed's going to do what it needs to do to keep that economy going, because they're not about to give the Biden administration a recession, in the quarter or two, leading up to the time people make their decisions to vote next fall.
All right, let's talk about another energy sector, because we did have some news out of ExxonMobil. So a large oil and gas producer, but entering the lithium game, saying that they are developing their own DLE technology with some pretty aggressive plans for production of lithium. How much does this potentially change the whole lithium market when we do have a multi-billion-dollar company saying that they're going to be focusing more on developing their own DLE technology?
Yeah, isn't that something? I'm glad you brought that up. Yeah, here comes Exxon, very deep pockets. They've got small armies of engineers and PhDs, technically competent. They're talking about producing brine water. In this particular case, it's called the Smackover Formation. It's in Arkansas and northern Mississippi, and it's rich in lithium. And so in terms of producing brine water, running it through a separation system. I mean, a company like Exxon, they've got the money, they've got the people, they can acquire the technology, they can, to be cynical, they can throw enough money at it to make it work. And they're not known for losing money on operations. I mean, they I'm sure, no doubt, that they have scoped this out internally down to some pretty tight engineering. This is not just some harebrained faculty lounge idea. No, this is a real thing. Obviously Exxon wants to do it for political reasons too, because lithium's hot, and people hate. Politicians hate oil companies. They love to hate oil companies, although they always cash their checks. But here's Exxon coming out saying, okay, great. You want us to be green? We're green. See, we're doing lithium. As far as the rest of the lithium sector, I'd be careful. I'd be watching, because that's whatever Exxon comes out with. It's probably going to be in the low part of the price range. So if you're a lithium, wannabe out there, if you can't beat the Exxon price, well, good luck. So I do think that the entry of a really big company, really deep pockets, great technical background, is something to watch as this thing evolves. And then meanwhile, just in terms of how much lithium does the world need? Well, more than what we produce, but at the same time, it's probably not news to many listeners or readers out there that that there's a lot of resistance out there in buyer land to EVs. I mean, there were the first adopters who went out there and they bought their Teslas and they bought their EVs and from whomever were making them. But you hear these stories about the auto dealers in America saying, the consumers, they just don't want these things. They don't want to buy them. They want the gasoline or they want the diesel. And in a lot of respects, an electric car is nice for, tooling around town, and if that's all you're going to do. But they still have the range anxiety thing. They still have the charging anxiety thing to get over. So what I'm saying is that I think that this rapid move, this tsunami of movement towards the EV world is going to be slowing down. That's going to affect lithium. That's going to affect other things too, rare earths and what have you. Not that we won't need the lithium, not that we won't need the rare earths, not that we won't need the copper, but I think it buys time on the calendar. It buys time it moves a lot of things to the right in terms of the timeline.
Oh, we've already seen the lithium price more or less collapse, but it's all about this DLE technology and how much more lithium it could free up for production and supply the market here. So Byron, are you in any lithium companies? Are you interested in lithium companies, or are you just more a spectator right now?
Well, I'm looking at a couple of let's call them private deals, in the U.S. and Canada, and one in South America. high grade pegmatite type deposits full of spodumene, which is the mineral that has the lithium in it. There are some pretty interesting plays out there. I mean, places like South Dakota, for example. Some years ago, I was one of the early writers who was talking about Piedmont lithium. And they've done well. Piedmont has, and so I'm not walking away from it, but I'm not jumping in with both feet either. I think there are other opportunities out there. I mean, right now, in a macro sense, I mean, gold has moved. I mean, just since the Federal Reserve made its announcement, gold popped, I think, $40 within, I don't know, an hour of the Federal Reserve announcement just the other day. So I think we're going to see a lot more movement in gold and silver this year, and I really do think that some of that's going to translate into the mining sector itself.
So do you think broadly that the party's on for markets, for metals, this whole pivot party term that's been thrown around now that the Fed seems to be pricing in, or at least telling us that there will be rate cuts? Is this just a better environment across the board for metals in your eyes?
I think it's a better environment, although, I think you still have to be a stock picker. You really have to look at each company as to who they are, what they are, what's the track record in terms of management meeting their goals. There are still plenty of challenges out there, and that's just looking in, say, the next year, 2024. When you look out 2 or 3 or 4 years, I mean, the stories that we've been hearing for a long time about old mines that are running down. I mean, the average year of discovery for the top, I think 10 or 12 copper mines in the world, the average year of discovery was 1928. I mean, you're looking. I mean, a mine like Bingham Canyon, Utah, for example. Bingham Canyon, I think, delivered the first ore in 1907 years ago. They have pretty much open pitted it down to where the hole in the ground is choked, and now they have to go underground, which means that they're constrained to mine to chase the high grade. So I think copper is still a very good place to be for the medium and certainly the long term. Our buddy Robert Friedland not too long ago was talking about if things go the way they're going, we could be looking at a 10x move in copper. Now that's Robert Friedland talking, and he loves to talk about things like that. But I'm not going to call it 10x, but I am going to say that we're going to see higher copper prices substantially over the next couple of years. And so if you're looking to position yourself now or in 2024, keep your eye on the ball for copper and copper companies.
All right, Byron, I'm going to get you out of here on that one. So thank you very much for your insights on the energy markets and broadly on the metals markets. I'll chat with you probably next month, and we'll talk a little bit more on the resource markets and what is catching your eye. Byron, thank you very much for your time today. Hope you have a great weekend.
Thank you much. Appreciate it.